Over the past 2 years, the stock market has gone pretty much nowhere. If you look at the stock market from November 2021 to November 2023, you can pretty much draw a straight line across the results. It's like a roller coaster. Up, down, and in the end, you're right back to where you started. In my own portfolios, I've been consistently buying across this time, but even so, I've only just recently been able to make a profit. And if you've only just started investing, like I'm sure many of you have, you're probably feeling pretty disheartened, especially when everyone has promised you 10% returns, which we've seen from the S&P 500 across the past 10 years, and made it seem like smooth sailing. You probably feel like you're stuck in the mud, spinning your wheels, and you're not able to get very far at all.
That's a bit harsh.
So let's discuss what the hell is going on and what's caused this mess, and more importantly, what you should do to get through this rocky time, and how this affects you going forward.
It was a very different Britain that woke up this morning.
Our journey begins in late 2021, still in the grips of the COVID-19 pandemic.
The coronavirus is the biggest threat this country has faced for decades.
While much of the world had started to recover, new variants and waves of the virus continue to cause economic disruptions.
The rules around travelling into the UK have been tightened again in a bid to control the spread of the new Omicron variant of COVID.
This caused the market to fluctuate with every mention of lockdown, vaccine rollout, and government stimulus checks. One prime example of the ripple effect of COVID is a company listed on the stock market which was severely impacted by the COVID-19 lockdowns, American Airlines.
And United Airlines is cutting its flight capacity in half in April and May and expects cuts to extend to the summer.
The airline industry as a whole took a significant hit.
Flying has been reduced by 80% all around the world.
But at one point, American Airlines stock dropped 45%. This decline was due to safety rules that reduced the number of flights and passengers able to travel, especially in the early stages of the pandemic.
I must give the British people a very simple instruction. You must stay at home.
Even though post-pandemic the airlines increased their flights, spikes in the virus, slow vaccine rollouts, and various state and country restrictions continued to limit air travel constantly. While on the surface of it, it looks like bad news directly for American Airlines, but the picture was much wider. As a major airline, American Airlines plays a key role in the global supply chain, including the transportation of goods and cargo. The reduction in flights saw a huge impact on global imports. Companies providing in-flight catering, airport retail, and other ground services to airlines also suffered. With fewer flights and passengers, the demand for these services plummeted. Manufacturers of aircraft and parts, as well as companies providing maintenance services, faced a downturn. Airlines, facing financial constraints, delayed and cancelled orders for new aircraft and scaled back on maintenance and expenditures. The ripple effect on employment was significant. Businesses in the aviation ecosystem, such as suppliers and service providers, had to cut jobs or reduce hours due to decreased demand from airlines. The struggles of major airlines like American Airlines impacted investor confidence in the broader travel and transport sectors. This led to a cautious approach in the investments in these sectors, which had a huge impact on the stock price. Many companies rely on air travel for business operations, including meetings, conferences, and site visits. The reduction in airline services affected the abilities of these companies to conduct business as usual, leading to an increased reliance on digital communication and businesses re-evaluating their travel needs. And the fuel industry suffered with less demand for jet fuel due to the reduced flights. The oil and fuel industry also faced a downturn which hit businesses in that sector too. The airline industry is also closely tied to the tourism and hospitality sector. With fewer flights and travel restrictions, hotels, resorts and tourist attractions faced a steep decline in customers, leading to financial hardships for these businesses. Each of these effects showcases the interconnectedness of the industries and how a major disruption in one area, like the airline industry, can have far-reaching consequences on other various sectors. And these ripple effects are still being felt by supply chains, affecting businesses that rely on them for air transport, importing and exporting goods, and that's a knock-on effects of just one company. Coupled with this is what I call the sleeping giants. As we moved into 2022, inflation emerged as a dominant theme.
Everything that we buy is going up at the fastest rate for 30 years.
You just think to yourself, like, how is this going to get better?
Prices for goods and services soared globally, partly due to ongoing supply chain issues and increased customer demand.
People don't have the extra income anymore.
Central banks, notably the Federal Reserve, responded with interest rate hikes, aiming to cool down the overheating economies. What we saw over the next period and hence a lot of the up and downs in the market was a battle of tug of war between inflation and the labour market. The simple way to look at it is that when the labour market is strong, the belief is that people have more money. People are in work and in theory have more cash available to spend, so consumer spending is higher. And businesses have more faith that companies will thrive off the back of it. What this also causes though is inflationary pressure. There's more money, hence more inflation, and then the central banks raise their rates to help counter it. So that's a large part of why you've seen this up and down in the stock markets. Here's a timeline of events that have unfolded. In late 2021, the labour market showed signs of recovery with decreasing unemployment rates. However, there was a concern about labour shortages and rising wages contributing to inflation rising. Through early to mid-2022, inflation rates surged, hitting multi-decade highs in many countries, as high as double-digit figures for the first time in over 40 years. This hit growth in tech stocks particularly hard. Investors started to pivot more towards inflation-resistant sectors. The Federal Reserve and other central banks begin implementing aggressive policies, including multiple interest rate hikes, to try and combat the inflation. This led to further market volatility, as higher interest rates generally lead to lower stock valuations. By late 2022, the labour market had high demand for workers and there were rising wages, which further fueled inflationary concerns. And then, in early 2023, the market started to adjust to the new normal of high interest rates and continued inflation, though possibly at a slower pace. The market remained strong, but showed signs of cooling as some sectors adjusted to the new economic reality. And in mid to late 2023, market volatility persisted, reflecting ongoing concerns about inflation, interest rates, and the labour market's impact. There was a cautious optimism by some that inflation may be peaking, but uncertainties remained. The entire period from 2021 to 2023 was marked by this interplay between inflationary pressures, the labour market, and central bank policies, all which created a complex and often unpredictable environment for stock markets worldwide.
Well, the conflict in Ukraine and the sanctions on Russia have led to another surge in the cost of oil and gas.
We've also had a heck of a ride with energy prices. Throughout 2022 and 2023, geopolitical tensions significantly impacted the global energy market, particularly due to the Ukraine-Russia crisis. Russia used its energy exports as a tool, significantly affecting Europe's energy supply.
It's terrifying that we've had this much at this stage and we don't know what's to come.
Export disruptions, either as a response to sanctions or as a deterrent to Western support for Ukraine, made it difficult for Europe to manage its energy supplies.
We cannot trust on reliable conditions with Russia, trade conditions on gas, and therefore we have to diversify our energy supply.
This situation led to increased energy crisis in Europe, driving up utility bills and disrupting industrial activities. So, while effectively we punished Russia, we also punished ourselves. European countries accelerated their efforts to diversify their gas supplies and invest in renewable energies to reduce their dependence on Russian gas. However, these measures would take years to become effective. With escalating tensions between Russia and the West, Russia's pivot to the east sped up. Countries like China and India benefited from importing more Russian energy, which helped them diversifying their energy sources and boosting security. However, this increased reliance on Russian energy also meant that these countries need to navigate their political landscape carefully, especially concerning potential secondary sanctions from the US and EU. As you can imagine, these series of events have had an ongoing ripple effect across businesses worldwide.
I've spent the last 24 hours trying to get my head around why so many people lost so much money.
The one sector that seemed almost immune to COVID was the tech sector.
As warehouses empty and the cargo ships currently sailing stop arriving as frequently, we can expect to see a shortage of goods and rising prices as demand increases.
As life began to return to normal, the extraordinary growth rates that these companies had enjoyed, in particular due to the increased reliance on these companies, started to normalize.
It really led to the valuations of a lot of these tech companies to become really inflated, really lofty.
Investors began to question the sky-high valuations of tech giants, leading to significant corrections in the tech sector.
Previously, we were all at home, ordering stuff online again, and now we're shifting back and going back in person.
A prime example of this being Amazon stock, which rapidly increased during the pandemic, came crashing down to normality by early 2023. As you can imagine, with a huge portion of the stock market being made up with these tech stocks, when they fall, the market feels it. Equally, when they rise, the market also feels it. The drop we saw in 2022 gave people the opportunity to pick up stocks they had just seen soar in times of trouble at much more reasonable valuations. Stocks which were once vastly overvalued had almost become on sale. This sharp drop also forced companies to shift their focus to costs and their profitability, especially with the surrounding economic factors, which was seen as a positive sign to investors. Also, through this period of decline, despite the drop in valuation in a lot of these tech companies, they have still been able to show growth and outperform other sectors. The worry with this, of course, particularly at this moment in time, is the market being held up massively by these tech companies, and not giving us a clear picture of the current state of the stock market. There's also been a big shift because of the rise in environmental, social and governance, which is called ESG investing. This has significantly influenced the stock market.
ESG at the level of corporates essentially reflects companies' attempts to integrate environmental and social issues into the way they do business, into their business model, and into their strategy.
This change has resulted in an investing shift, with increased investments in industries known for the sustainable practices, such as renewable energy, while sectors with perceived poor ESG performance like fossil fuels have seen a decline in investor interest. This trend is influenced by regulatory changes and public sentiment, and of course global events like the COVID-19 pandemic, which has emphasised the importance of responsible corporate behaviour.
Investors used to think that socially responsible investing would eat into a company's profit and competitive advantage. Now investors see it as an opportunity to identify potential risks or even disasters before they happen.
There's also been a big surge in ESG funds. However, challenges remain, particularly in the standardization of ESG metrics and their reporting, which affects the ability to assess and compare companies' ESG performance accurately.
One of the things that we have found is that depending on the model that you're using, you might be getting very different estimates.
But overall, ESG investing is leading to a transformation in the stock market. After all, people want to invest in responsible and sustainable companies. The one sector you may not have expected to impact things is emerging markets. Over the past 2 years, emerging markets have had a notable impact on the stock market, presenting both opportunities and challenges. These markets, which include countries with rapidly growing economies like India and Brazil, offer unique growth prospects. This makes them attractive for investors looking for diversification beyond more established markets of North America and Europe. However, investing in emerging markets also comes with increased risks. These markets are more vulnerable to political instability, economic fluctuations, and changes in currency valuations, which can lead to greater volatility in the global stock market. The COVID-19 pandemic highlighted this vulnerability, as some emerging market economies struggled more than developed countries, affecting the stock markets and investor confidence. Also, emerging markets are more sensitive to global economic changes, like interest rate adjustments in the United States, which can lead to sudden shifts in investment flows. And unfortunately, because of their instability, they haven't dealt with the other factors we've discussed as well as developed countries. They've pretty much fallen and they've not come back up. The outlook for these is more positive in the future, so watch this space. These factors have all played such a huge role in the stock market over the past 2 years. It leads to the question, is the stock market really dead? Well, the truth is, despite all of these complex factors affecting the stock market is, in essence, pretty simple. It's made up of companies that need to grow. And as those companies grow, we make money. And in order for it to grow, there needs to be the ideal market conditions. The thing you also have to remember, which is hard to get your head around, is the stock market is massively made up on perception. It's like a designer handbag. I could tell you that a bag was a £20 handbag or a £20,000 one-of-a-kind Hermes handbag. It's what you perceive to be value. So at some point, despite whether the company is profitable or not, it's what the public's perception is of that company's value and how they'll be affected by the current conditions. And with quite scary swings going on globally, it's pretty clear the stock market isn't dead. I mean, look at all those up and downs. But it does leave you feeling like when you look at your portfolio 2 years later and think, meh. I mean, you would have had better returns if you'd gone for cash interest. So what does that actually mean about where we are right now and what's to come? Well, the important thing to remember is stock markets work in cycles. and periods of stagnation or correction are natural. These phases set the stage for future growth and investment opportunities. For long-term investors, this could be an opportune time to invest in undervalued stocks. Market downturns often uncover hidden gems, companies with strong fundamentals but temporarily out of favour. But if you're like me, investing in index funds, you're likely not going to be trying to pick those companies. You're just buying your index fund every month. And this is where you need to realise the importance of staying the course. While in the short term, a 5% rate of return might seem quite appealing right now, when the stock market has a plus 10 or plus 20% year, you sure won't think so. And while you may look at my chart and drawing a straight line seems pretty depressing, you also have to look at all of these points and realise they are lower than where we are today. Then when you zoom out to see my total profits, despite the stock market rate of return not being fantastic, because I bought consistently, when the market has dipped, my overall position is up. And when the market decides to take a big shift upwards, I'll have kept stashing my money in there for when it does come. It may surprise you to hear me say it, but I don't want the stock market to rise, at least not yet. Let me get as much money in there as possible before the next upward cycle. History has shown that markets recover over time. Adopting a long-term perspective and diversifying your portfolio are the key to navigating these volatile times. While the market may face these periods of stagnation, these can be seen as opportunities for strategic investment and portfolio growth. The market isn't dead, it's merely at a stagnant stage. So despite how discouraging it may feel at the moment, keep putting as much away as possible, buy on a consistent basis, and you will see the results. If you want to follow my journey, be sure you're subscribed, and if you haven't seen my latest portfolio update, check it out right here where you can see exactly how much I've got. Thanks.